Hi, I'm Jeff Hirsch. We're here at the Money Show Orlando. I'm with Ellman, president of thebluecollarinvestor.com. That's www.thebluecollarinvestor.com. And you cover call writing, put writing's your thing, and you're one of the top people at that. But you have different strategies for bull markets and bear markets. First, how do you tell whether we're in a bull or a bear market?
Well, first thing I do is I take a look at the chart of the S&P 500, which is the market. And I take a look at the chart, and I also look at the chart of the VIX, which is normally inversely related to the S&P 500. In addition to that, I look at all the economic reports that came out that particular week, and I get a general mosaic of whether it's bullish or bearish. And the third thing I look at is the Gmi Index, which was developed by Dr. Eric Wish from the University of Maryland.
What's the GMI? I'm not familiar with it.
General Market Index.
Okay.
And it basically is 6 different indicators, technical indicators, that will give a general market assessment. I've found over the years that that's a fairly reliable indicator.
Moving averages and that sort of thing?
Yes, moving averages on different stocks and different benchmarks. So it's 6 different indicators, so you'll get a reading of 1 out of 6, 5 out of 6, 6 out of 6, and it'll give a buy signal or a sell signal. So I look at that, and I look at the IBD market assessment as well. Currently, the IBD assessment is bullish, GMI is bullish.
So we're in a bull market?
I would say right now we're in
Newsflash.
a bull market, yes. Yeah, I guess people have noticed that portfolios are getting better.
So what do you do differently in this bull market versus a bear market that we haven't seen in a little while?
Well, in bull markets, I favor covered call writing over put selling. And the type of strike that we're going to use and the type of underlying security we're going to use is very important to take advantage of that. So I'm more likely to use a higher implied volatility underlying security in a bull market.
For example, what's a higher?
For example, I might go with a tech company or a biotech like IBB is an indicator.
The ETF,
or an ETF.
The NASDAQ biotech
right,
ETF.
Or GDX when gold is performing well. For individual stocks, I might go with a growth tech company.
Like an Amazon or a Google or...
Well, you can go with those, but those are almost, a lot of them are almost blue chip companies, except around earnings reports. But the way I tell the implied volatility is not necessarily to look up the IV, but to take a look at the 1 month return that I generate for near the money strike. My goal is 2 to 4%.
That's pretty healthy for a month.
Near the money strike for these growth companies. Now, I'll go as high as 6% in a raging bull market, but never higher than that, because the implied volatility will then be through the roof, and the risks to the downside will be too great for my type of trading. So that's how I determine in a bull market, but I will only use out of the money strikes in a strong bull market, and I'll go in the money strikes for covered calls in a bearish market.
And what about the put side?
Now on the put side in a bear market, I take advantage of selling an out of the money put, and again, 2 to 4% is my range. If I'm very bearish, I'll go closer to 2%, so I'm deeper out of the money.
Right.
And then if it's exercised and assigned to me, then I'll write an in-the-money covered call. So I'll have the protection of the out-of-the-money put and then the protection of the in-the-money call. So I get 2 layers of protection, which means the stock can go down 10 to 15%, and I still haven't lost any money yet.
Fantastic. Thank you, Alan, and thanks everybody for joining us.